What's up, everybody? Welcome to the Real Estate Wire. Today, we're going to be talking about the 5 biggest issues that we face in the real estate market today. We're also going to be talking about the real estate hot or not, what the heck happened with SVB, and we got some special announcements today. Welcome to the Real Estate Wire, folks.
Solid, brother.
Try.
What's going on, everybody? I'm Dan the Realtor.
Mortgage Coach Marcus.
Today, we got a lot to talk about.
We got a lot to talk
So,
about. You'll get it.
let's talk about this the SVB, man, real quick. We're gonna get into it because I think the top mortgage headline that we got going, well, the top real estate headline we got going on right now, and the headlines everywhere is what's going on with SVB Bank. Well, the SVB, right? The Silicon Valley Bank.
Mm-hmm.
And so, from my brief understanding, there was a bank that got over leveraged.
Long and
short. They had too much money. And because they had so much money, they were taking risky bets. They invested in a lot of crypto. We all know crypto is trash. Don't come for me, or you can come for me if you want to. Crypto's trash. Crypto been trash. I never threw a dime in crypto. It's always been trash, always will be trash. Blockchain technology is
Say it
amazing.
with your chest. Say it with your chest.
Blockchain technology is amazing. Crypto is trash because it's nothing.
Mm-hmm.
I mean, we may as well be trading baseball cards. So I know y'all gonna say, "No, man, crypto, you stupid. Crypto, okay, cool, fair enough. I'll just stick with real estate. I'll stick with real estate." And so, they invested in a bunch of risky assets.
Yeah.
And then sellers, the people who had money in the bank, they all wanted their money back.
Yeah.
And SVB was like, we don't got it. So then SVB tried to sell the bonds. But the problem with bonds is if you buy bonds, most people buy bonds because bonds are secured by the federal government.
Right.
So if you buy a $10 bond, at 5%, at maturity, however long the maturity date, whether it's a 10-year or a 20-year or 30-year, at the end of that maturity date, you're supposed to be guaranteed to get your money back at that interest rate.
Right.
Irrespective of what happens with the market, that's what bonds are for. And so because there was such an influx of cash over the past 2 years, where there was basically trillions of dollars blown into the economy because of, the pandemic, you can hear those air quotes, the pandemic, right? Then everybody was making all these risky bets because you get free money, you don't earn it, you're going to make risky bets. That's why, a lot of people were putting their money in crypto and Dogecoin and all these, speculative, quote unquote, investments, which is really just speculation. And, the chickens came home to roost because crypto crashed, the interest rates, the inflation is what happens when you pour money on people. Yeah. If you give a whole bunch of people money, they're going to go spend it. And when you have a large amount of money chasing a finite amount of goods, that pushes the prices up. That's pretty much what inflation is in a nutshell.
Mm-hmm. And I think the fact that they invested this money, so they were giving a lot of money to these startups, right? These startup companies, and when you're giving money to a startup, they can give you a good business plan. They can say, okay, this is what we believe will happen, but then you still got to make it happen. Yeah. And so if you're investing this money into a startup, and then now the money, whatever money's come back, now you're investing that somewhere else. The money keeps moving, and I don't really have it.
You don't got it.
I don't really have it.
And these risky investments, these startups, crypto is what a lot of the Silicon Valley Bank and a few other banks associated with them were investing in. Well, all those so-called speculative investments went belly up. Then SVB attempted to sell their bonds, but the problem is because of inflation, the Fed raised the interest rates that we know to 7.5%. Well, if you bought the bond at 4%, and you try to sell it and it's at 7%, you can't sell it at 7% because you only bought it at 4%, so you're going to sell it at a loss.
At a loss, yeah.
And so that's what happened with SVB Bank. They had to sell these bonds at a loss, and they didn't have enough money to pay their investors. Yeah. And therefore, they had to declare I think they just declared bankruptcy this morning. So over the weekend, the government was like, oh, crap. Instead of just letting the bank fail, which they probably should have just let the bank fail or let other banks buy them up, the federal government decided to step in, as they do, and basically guarantee, this is where I have an issue with it, they basically guaranteed anybody over $250,000 that they're going to cover their losses, which they really aren't supposed to do. The federal FDIC, Federal Deposit Insurance Company, only guarantees your deposits up to, for at a maximum of $250,000.
Right.
And so anything above $250,000, if you have it in the bank, you are subject. You're subject to loss.
Get it back, yeah.
Yeah, which is why most people who have more than $250,000 do not keep all their money in one bank.
Right. Well, so that says something to me that if the federal government comes and steps in to a bank in this position, that means that the federal government has a vested interest. To me, it makes sense. Like, oh, they got a vested interest specifically in this institution. Because larger institutions, I think the government would have some sort of view and some sort of connection there, of course. But it's like, what about the smaller ones though? Like,
yeah, the smaller banks, like, they don't care about the smaller banks
because we know that the middle class occupies the largest class of all of our citizens, right?
Yeah.
So your average middle class person is not investing money into higher level.
Most middle class people aren't affected. The challenge that they're running into, what we were talking about before we started recording, which was people who don't even have $250,000 in the bank are getting scared and they're pulling their money out of the bank, which is the stupidest thing you could ever do.
Yeah, keep your money in the bank.
Keep your money in the bank. If you got less than $250,000 in the bank, if you only got $5,000 in the bank, why are you pulling your money out of the bank? But it's this herd mentality, and the herd always goes off the cliff.
Well, it's like, when you see different like videos and memes on social media, whatever, and I think we can laugh about it, like you see like in movies, right? And in the movies, black folks start running. One black folks start running, everybody else will start running. Yeah, like we ain't waiting to ask questions and figure out what's what.
Kalisha, come on, Kalisha, we gotta go.
Yeah, and Jason Voorhees ain't getting me. You know what I'm saying? Somebody else can get got. But,
right, and that's what the federal government is trying to avoid, and in my opinion, unsuccessfully. They're trying to avoid runs on the bank, so they basically guaranteed everybody's deposits, which they're not. That's not the federal government's job.
Correct. And see, here's the other piece, right? In 2008, when Lehman Brothers crashed, it began to snowball into other financial institutions,
right,
which affected everything in our mortgage and real estate world, right?
Yep.
But I think that we do face some sort of low level danger with this. I don't know. I'm not an economist, and neither one of us are, so I really couldn't tell you from that perspective. But I will say this: I know that if we look back 15 years and hit 2008, and we say what was around then, nothing. There was no protection. There was no seatbelts. There was nothing. So now we've got the Consumer Finance Protection Bureau, CFPB. There I go stumbling over that word again. We've got RESPA. Real Estate Settlement and Practices Act. We've got these things, the FCRA, Fair Credit Reporting Act, and all these different acts that have come into place since the crash.
Right.
There's a level of protection that exists for banks, mortgage companies, correspondent lenders. As a buyer or or a homeowner or whatever, like I have a level of protection now that I didn't have before. And if we're talking about the real estate bottom falling out, or we're going into this super recession, or the market's going to crash because of what you see here, don't let what the media puts out here, because it's pretty hot. And we don't know all the story yet, but it's pretty hot. So don't let this thing scare you from what we've been talking about the whole time. Find ways to invest in yourself. And one of the greatest investments outside of education is making sure that you have a sound financial picture, and you start that with real estate. Nothing is more sound and stable than having real estate. And
that leads to our first real estate topic, which is the top 5 issues that are facing the housing market today. And this article that I read really highlights the difference between what's happening now with SVB and what happened with Lehman Brothers.
Okay.
And one of the biggest issues that we had that really facilitated that crash is, if you listen to some of our previous episodes, we've talked pretty extensively about how the '08 crisis happened, what kicked it off. There was not only, now a lot of people blame subprime mortgages, which I think only shows half of the picture. Not only was there subprime mortgages, but a lot of investors were caused that crash too. It was a what would you call it? It was a perfect storm of idiocy and greed in '08 that caused that.
It's so many, man.
There was a lot.
People.
And so what the impetus was, okay, I'm going to buy a house. I'm going to put some paint and carpet in there, and then I'm going to push the price up. I'm going to flip it in a week or 2 weeks. That was when they put those, like you said, those regulations in place, especially FHA.
Right.
If I buy a house to rehab and I try to sell it in less than, is it 90 days?
On FHA?
FHA. And I try to sell it less than 90 days, then when the title transferred, I can't sell it.
You can't. So here, let me also give you a little bit of add on to that guideline. The contract can't even be written until day 91.
Yep. So that is one of the biggest issues that was happening in 2008. I could buy a house today, put some paint and carpet on the joint, or maybe not even do that. And I could literally flip it the next day for $50,000, $60,000, $70,000. So it wasn't just the subprime, mom and pops that were getting in over their head like everybody tries to blame them for. Yeah. It was also investors, greedy investors who didn't really know what the heck they were doing, or they knew what the heck they were doing, but they were just taking advantage of a loophole, which was, hey, I can buy this property today. The market's going up so high, and then sell it tomorrow for $50,000. I'm gonna do it, right?
Yeah,
that was one big issue. And then, boom, the chickens came home to roost. Banks started collapsing because not only did that happen, but they collateralized a lot of these subprime mortgages. And so for us in the cheap seats, what does that mean? If I'm giving you a loan, like we were talking about last week, lending practices have gotten so strict now and so much more tight that you have to be very well qualified in order to get a loan, to qualify for a house.
You got to have your stuff together. Like and well qualified doesn't mean everybody got to have a 700 credit score. That doesn't. Right. But well qualified is defined a number of ways. It just basically means if you have some previous issues, you got to be able to have explanations or say what's the deal.
Like what's the deal?
You can't show a pattern of bad decision making.
Correct. And that's what was really different in 2008. Yeah. RESPA created that. FHA created those new guidelines so that we didn't run into an entire country of buyers, homeowners who probably, and for all intents and purposes, should not have had loans. We don't have that now. So that's factor number 2. That's different from the 2008 than today, right? The next factor that we're running into so now so they collateralized all that debt, right? And they said, okay, we're going to take a bunch of these subprime loans, package them together, and aggregate the risk over all of these loans. In other words, all of these joints can't fail at one time, right? It's impossible for all of these. All of these guys can't fail. So therefore, since we don't think that all of these loans are going to fail at one time, we're going to call these grade A loans. We're going to package these loans like we talked about last week, where your lender, when you buy a house, Marcus is going to get you a house. And you're going to pay your first mortgage payment to Marcus, to Phil's Mortgage Group. And then Phil's Mortgage Group is going to sell that joint to what's called a mortgage servicer. Yeah. Your mortgage servicer is the one you're actually going to make your payments to. And then the lender's going to sell that loan, and they don't keep your loan at house. Some lenders do, but most lenders sell it to mortgage services. Yeah. Now, why is that important? Because when you sell these loans on the secondary market, like we talked about a few episodes ago, the secondary market doesn't know every single profile that's in this package of loans. They just assume that it's probably going to be a good loan because they grade it. And what they did in 2008 was they said, yeah, these are all grade A loans, even though they were subprime. Long story short, a lot of those people stopped paying their mortgages because they didn't have jobs or didn't have income and they shouldn't have it anyway. And then that tumbled. They sold those collateralized loans on the stock market. Yeah. And when all those loans went bad, the stock market crashed. And then that caused Lehman Brothers to crash and all these different insurance companies to crash. And then it kind of created a trickle-down effect from there.
You're very smart because you weren't around wasn't you born in 2007?
Wow.
You was only a year old when you.
Wow. I look young. I do. I know. I'm black don't crack.
Hey, Ken Bacon said black will crack if you don't take care.
You don't take care. I moisturize, Ken. Not as much as you, but I don't think there's enough moisturizer. No, I can't catch up with him.
Ken told me that somebody told him, he was like, man, you were extra greasy.
Hey Ken, we just got off the phone with Ken. Ken, we love you, bro. Can't wait to have you back. So here's where we are with the SVB versus what's going on today. Inventory. The biggest issue that we had during 2008 was after the crashes happened and people lost their homes, which put a pin in that. I think it's really sad that people are hoping for a crash. Like, ignorant people are hoping for a crash.
And it's not going to happen.
And even if it does, well, I think what we're defining as a crash, we can talk about that on another discussion. But I think it's really disgusting that you're thinking that you are so financially savvy that in the event that the market crashes and then you're going to go up and buy a whole bunch of properties, like, you don't have no property now. So why do you think that you're going to be able to take advantage of some like crash situation? Are you in that position to do that? Like, stop hoping for a crash. Shut up. Because when the market crashes, people lose their houses, people lose their jobs. It's not something to hope for. Now, it could have happened, sure. And if it does happen, okay. But stop hoping for it. That's
funny,
ignorant,
but
man.
it's funny. I feel that because I've never seen the positives of like trying to capitalize on somebody else's.
I've never seen it's like, oh man, I can't wait for. Shut up.
But something else is, and I'll bring it to the sports world when like you hear like you and I are just regular guys, right? But we're watching this NBA coach or NFL coach try to do whatever with his players and lead his teams to victory and all these other things.
Yeah,
and it's like. People on the sidelines saying like calling for his job. I'm like,
right. Or you hoping somebody get injured.
I'm like, how do you want somebody else to get fired because
terrible
because you don't like the job that they're doing that you can't do.
Right.
And then on top of that, when this man gets fired, okay, are they making a ton of money? Yeah, but that aside, we're saying, you got to go home and tell his wife I got fired and get kids and it's embarrassment.
These people, jumping in our comments, bills, hoping for catastrophes and all that. Here's the deal.
I ain't never like that.
It's silly. So let's get back to what I was talking about. I just wanted to address that.
Yeah, we got it all, but it's all right.
Yeah, no. I wanted to address that because I think it's silly, and most of the people hoping for a crash aren't even in a position to even take advantage of one. And the people that are in the position to take advantage of one ain't hoping for a crash because we buy in good markets and in bad markets. It doesn't. The market means nothing as long as you're buying fundamentally sound.
Buy.
And it's cash flowing, or it's a house that you like, then you buy. It's not about, I'm waiting. So, anyway.
I digress.
I digress. Let me jump off you got a ladder so I can get off my soapbox? Okay. I'm off the soapbox. This horse was a little bit high. Let me get off the high horse here. So, the biggest difference is inventory.
We're number 4.
No, we still on number 1. I know, because we had to break. I wanted to create the context.
Yeah.
We may not even be able to get to all of them because I don't want to belabor the issue, but I think this is the biggest one, which is the inventory.
Yeah.
So everything that we just said thus far is leading us up to where we are now, which is inventory.
Yeah.
The 08 crash, the subprime fiasco, the investors, the SVB inventory. After the subprime crash, we got flooded with inventory because banks took those properties back, like we talked about last week about REOs, and they turned them into REOs, and then they put them right back on the market.
And not only did that happen, because I feel like the REOs, which are the foreclosed properties, and people were buying them for less, right? That value of this townhouse right here compared to this townhouse who's not, like now this townhouse, that person could be still making their payment all right, but this one got sold for $200,000.
Right.
Well,
and theirs worth $450. But if they trying to sell it, they got a comp now, and they got comparable property that $200,000
sell it for $200,000. They got to sell it short sale. So now you already have the foreclosures in the market, and now you have other people that are like, well,
dude, right
now I'm gonna sell it, but it's gonna be a short sale. But the short sale and foreclosure, ultimately, the final decision-making authority is the lender that's in charge, where the mortgage is sitting.
Bro, that's a brilliant point. And that highlights another difference, which is one of these joints down here. But that highlights another difference, which is now, if you try to sell your okay, let's use that example. The bank floods the market with properties. Your house the house next door to you sells for $200,000. Your house is worth $400,000.
It was. How much you owe?
Exactly. How much do you owe on it is what makes the biggest difference.
Right.
So if what's going on right now, the amount of people who have positive equity in their house is the highest that we've ever seen in the history of America. Most people who own their houses have seen at least a 20%. I know I did. Mm-hmm. I'm sure you did. Have seen a 20% increase in their equity. In addition to that, you still have your mortgage pay down, which is also increasing your equity because you're paying down your mortgage. So the difference is, during 2008, there was nobody had equity because everybody was over leveraged. A lot of people did cash out refis, and that was before the regulation where they allowed you to pull out 100% of the cash of the equity of your property. Now they only let you do like 70% of the equity. They'll allow you to pull out.
Depending on where you go and what your situation is.
But sure, you can pull out more.
Yeah,
right. You can pull out about 70 to 80% of the equity. Mm-hmm. But they don't let you pull out all the equity, which is what people were doing. Yeah. They were using their houses as piggy banks.
The VA loans can still do it, but
VA loan, right. Most VA loans are responsible people.
I got you.
Yeah. But by and large,
I'm not trying.
By and large, that was another issue which is perfect that you brought it up. The flood of the inventory, and then that sunk people's houses. So if they decided that they wanted to sell, well, we got this $200,000 house that sold down the street that's bringing the house values down. Mm-hmm. But if you did a cash out refi, you still have equity in your property because the lender will not allow you to pull 100% of your equity out. They still require you to keep a little bit of that equity in there in the event something happens and you need to sell. So we've had the least amount of foreclosures and distress sales that we've had in the past 20 years.
Because we don't have the inventory.
Because we don't have the and people right now, they more than likely refied. And if they do need to sell, they have so much equity in their property. They just, instead of doing a short sale, most real estate agents going to look at it and be like, why don't you just sell the joint?
Correct. That's what you would tell somebody, right?
That's what I was. Look, if you're in trouble, just sell it. You're probably either going to break even. Yeah. Or you might have to bring a teeny bit to the table. Or guess what? Option number 3, just rent the joint out.
That's right? Always you make some money off it.
So this is one of the biggest, and so these conversations that me and Marcus are having are the conversations that the mainstream media do not have because they want to sell clicks. But as you can clearly see, there's a lot of nuance in this market.
Yeah, and I think that we always talk about real estate being hyper local. I think there's an element of somebody has a vested interest at a higher level, right? But nobody has more of a vested interest than us. You know, good lenders on the street, good realtors out here on the street. We have a vested interest in the people. Like we talked about that middle class that we're talking about, right? And that's who 99% of my clientele, consists of. That's probably for you as well. We're talking about the middle class. Sometimes it's the lower class. Every now and then, you get the higher, class. I don't even know whoever came up with that. I don't know, but because people are people. Right. So my interest is, I don't have an interest at a high level like that. My interest is that my feet are on the ground. I know what's going on out here. I can help you based on, and you can help them tailor whatever decision they make to their real needs.
Right.
And
that's I think one of the biggest issues that a lot of our guys are having. Some of the questions that they're having is, is this going to be the next 2008? No, it doesn't make any sense. During 2008, we had about 10.5 million homes on the market. Put that in context. Today, we have about 2.7 million homes on the market. So
down 80%.
Like it's so few houses that in our market, we're still having multiple bid situations. We're still seeing a home price appreciation, irrespective of everything that's happening in the market. And so this particular financial crisis, which I'll call it a crisis. I mean, banks is collapsing. Yes, we're not going to sugarcoat it, yo. This is not good.
No, it's not. Yeah,
it's not good.
It is a
Will it trickle down to the real estate market? I don't think so. I really don't. The last 1, 2, 3, 4, 5, 6 recessions that we have, because we're in a recession. I've been saying it. I'm calling it. I called it months ago. Y'all can fact check me. When they call a recession, you can say Dan Wheeler told you first that we already been in a recession. And the last 6 recessions that we had, interest rates, this is going to number 2. The last I know, because it's a lot, yo. Hey, this is the detail and the nuance that they're not getting. That's why we're here. Like, we provide this nuance, which is interest rates went down on the last 6 recessions that we had. So What do I think is going to happen? I think interest rates going to start going back down.
When you think?
I think. See, here's the thing.
No, not the long.
All right, the long story very short. How much time we got left? Here's the long story very short. In my humble opinion, the Federal Reserve is in between a rock and a hard place right now.
Mm-hmm.
If they raise the interest rates, that's going to screw over the banks because it's going to raise the bonds, and then their bonds are going to be worth crap, and people are going to lose. The consumer's going to lose confidence because the banks aren't going to have that backstop of the bond market in order to be able to sell their bonds in case there's a run on the bank. Because if the interest is at 7 and they bought the bonds back during COVID or during the pandemic at 4, they're all going to sell their bonds at a loss.
Mm-hmm.
Or the Federal Reserve got to lower the interest rates in order to meet the bond demand that these banks are going to eventually start calling their bonds, right? They're going to start needing to get that money from the federal government. So if the Federal Reserve lowers the interest rates, guess what's going to happen? Real estate and inflation is going to start kicking back up. So in my humble opinion, I think that the Federal Reserve, because they don't care about us, they care about banks and they care about the government and they care about big money. They don't care about little money like us. I think they're going to lower interest rates, which is going to increase inflation. That's going to increase the price of real estate. And we're going to jump into, I think this summer going to be crazy, yo. I think once they start dropping these interest rates to save the big banks, that's going to push interest rates back down. All the buyers are going to jump back in, and we're going to go into even more hyper sellers.
We're going to be back in the same cycle that we've been in for the past 3 years. And
yep, that's my prediction. Y'all can call me on. I'm calling it. I'm calling the prediction. I think if you haven't bought during this little lull that we have that we've had over the past like 6-7 months with these high interest rates, which is when you should have bought. You should have bought now because you could have got in with closing cost help from the seller. You could have got a full home inspection. Did you see that article? There was an article that talked about there's like, I think 30 or 40% of the people who bought their house over the past 2 years regret it.
I didn't see that one.
A lot of them are regretting it because they had to go so hard just to get the house.
Yeah.
A lot of people that didn't do home inspections, like there were issues with the house. They overpaid for the joints by like $100,000.
And they just emotionally tired. Because think about it. How long does it take you? How long do you think it takes to like settle in a home on average? 3 to 6 months? Probably 6 months.
It just depends. That's like a year,
right? Real talk. I still got stuff in the boxes that I still ain't really messed with.
Yeah,
because I ain't felt like it,
right?
And they're just sitting in storage or in the garage, or whatever. But like the average homeowner, let's say it takes them 6 months to get settled in. But it took them however many offers, seeing however many homes, and going through all the different things, and then mentally, emotionally, I paid $50,000 more for this house, and you're counting pennies, you're counting the energy, you're counting the time spent, and none of it you can get back.
Right.
You can get this money back now because your values are up, right? But you just are so when they say that 40% are like they kind of regret it, it's like, man, I had to do so much to get into this, and I haven't really yet been able to enjoy it. And the process of buying a home and finding a home should have a high level of enjoyment to it. There's stress is going to come with it,
for sure.
But it should be an enjoyable ride. And I think that's, I'm glad that they put something out like that.
Yeah, Zillow, it's right here. Zillow survey on pandemic buyers found that 3 out of 4 buyers in 2020 and 2021 have at least one regret about their home purchase. And now, don't get me wrong. Y'all are going to be like, well, you're a real estate agent. You told me to buy it. That ain't the point. Because I stand by it. I still think, I actually know, if you bought your house over the past 2 years, you got a really freaking great deal.
Yeah.
You'll never see it again.
Yeah.
But I never encouraged any of my buyers to buy a house without a home inspection. In fact, quite the opposite. A lot of my clients lost out on houses because I was always like, dude, don't give up your home inspection. Yeah. At least do a home inspection and don't make it contingent on the home inspection. But we still either going to do a walk and talk with an inspector.
Yeah, we need to know.
Yeah, because, I mean, they cost like $300, whatever. But at least you need to, like you said, you need to know. Or we were doing like full home inspections and just making them non-contingent home inspections. But people was just going crazy. And so that goes to our...
They're doing it again now.
I think it's going to come back because...
No, it's back.
Dude.
I've had...
Wow.
Look, I'll just give you a real quick story. My boy's wife there was a listing, 1.4 million, okay? But there was another property down in Georgia. It was only like $375. Same situation. So, yeah, this price, my buyers offered this price. 300,000 in this 1.4 million situation. They offered 1.7.
Whew.
They lost because somebody bought the house at 1.9 in cash. Right. My boy down in Georgia, 375 sales price. It was a remodeling. The people owned it for like 2 years, right? So it wasn't a flip, but it was a remodel. Put it on the market, open house on the weekend. Jokers had, I think, 14 offers, and the person that got it for $20,000 above list price.
Okay.
No home inspection.
Whew.
No, waive all the contingencies.
Gee, yeah, and that's
No inspections, no contingencies, none of that.
You guys can fact check me, quote me. My opinion is that this summer, if the Federal Reserve lowers interest rates, which I believe they're going to do, I think they're going to give up on inflation. I think they're going to give up even trying to fix inflation. I think that we're just, instead of them raising taxes, I think they're just going to, inflation is a tax, whether you believe it or not. Inflation is tax, because if you got to pay $10 for a carton of eggs, that's tax. Who's that hitting? Multimillionaires or regular folks?
Regular folks. That's why everybody got chickens now.
That's what I'm saying. You know what I'm saying? Rich folks, they eat golden eggs. We eat we eat regular eggs. We eat farm fresh eggs though, just in case. Even though farm fresh is a scam. That's a whole
Farm fresh. What is that? What's farm fresh? A store?
No, it's a scam, dog. This is what they say. All right, this is what they say.
Is farm fresh a store?
Nah, farm fresh is like, so they got like organic, they got regular, and then they have what they call like farm fresh, which is like
in any and every store you're talking about.
Yeah, like it's like a certain. I mean, most of the time you're gonna go to like Whole Foods or like. I mean, they got them safe for
Farm fresh is a brand name.
It's it's supposed to be like a quality level, like a level of quality for your eggs.
All right,
and they call them farm. I could be saying it right.
You talking about cage
free, farm raised or whatever, but it's weak. It's fake. Let me tell you why. Because I was watching a documentary, as I am apt to do. And basically, the only thing that they need in order to qualify these chickens, because we not only eat the chickens, but we eat their unborn babies. And the only qualifications that they need in order to consider these chickens farm raised is they need to let them outside for like a specific period of time, like 10 minutes or a certain amount of time per day on the farm. But they're still like caged inside. It's like a deck. You know how your deck is outside, but it's still got a fence and you can't go into your yard unless you walk down the stairs, but ain't no stairs, right? That's the only qualification you need in order for them to be farm fresh.
So this is the thing that now I got to look into that. So there's a number, and you know where I'm from. There's a ton of farms. Everybody knows a farmer, right? Where we go, like our number one spot is Whiffle Tree Farms. Them jokers, like when I say they got hundreds of acres and they got a barn, a shed or whatever, a bunch of them that they move around. So that's where they bring the chickens into at night, so foxes don't get them, whatever. But every day, all day long, them chickens are out. They have turkeys or whatever. Everything is grass, and they don't give them any whatever. But those are the cage free range chickens. So I got you. If you want some real eggs,
holla at Phil's Mortgage Group. Not only will they get you a house, they also get you a basket of eggs with every closing. Yeah,
that'll be a closing gift.
Marcus guarantees his eggs. So we're gonna do the special announcement first, or we're gonna do the special announcement last? I think we should give him the special announcement first. Like,
you call it.
Let's do the special announcement, brother. What's going on? What you got new for us today?
Ooh, today, my 15-year dream comes to life. Today is the day that the Fields Mortgage Group has been born.
Let's go, brother. So what does that mean? So you started your own mortgage company, your own lending group?
Yeah, my own lending group. So I'm partnering with one of the largest, actually the largest real estate brokerage in the United States. The Fields Mortgage Group is going to be, I'm licensed in 10 states, but I have access to 39 other states. So my team and I were able to do pretty much any and everything that's out here on the market. So your easy loans, your clean loans, your vanilla loans, but also the more complex situations, multifamily properties, your super jumbo stuff, land development, church financing, commercial financing, you name it, I can get it done. And it gives me the opportunity to help grow some young men and women, but my heart is to see young black men get in this business because it's a great business, great career that helps not only bless you but everybody you're attached to. Great generational wealth opportunities. So I'll be able to help raise up some young guys and build this business. And I thank God for it. My family, my parents supported me. Like my dad was like one of my biggest supporters. Like, I can tell that story later, but in a later time. But my wife, really pushed me. She thought I was ready to do this 3 years ago, but I was like, but I wasn't ready. I just didn't see all the pieces.
Right.
But then on top of that, like every person that's helped me get to this part in my career with management, different companies, mentors that I've had and mentors that I still have, I'm super thankful for them to pour into me to help me get to this point. So we go forward, man. FMG, we here.
FMG, brother. Fields Mortgage Group.
Fields Mortgage Group.
I'm excited, man. We also got
and thank you.
Yeah,
because you've been really solid over the past couple of years since we met.
Yep.
And we've grown to this point. So
yeah, brother.
Appreciate you, brother.
Indeed, man.
Coffee cheers, I guess.
Cheers, brother. FMG.
For sure.
Let's get to the next mortgage headline, Coach Marcus.
Can we do how to not?
I thought you had a topic you wanted to talk about.
Oh, I was just going to talk about the rates. And we covered
the rates. Are we on the rates? Did we? We covered everything.
Yeah, rates are actually not bad. I mean, you get about 6.5 on a 30-year fixed FHA. Yeah. You're sitting on these are 30-year FHA, like 6.1 on FHA. Now, check this. I was able to lock a couple loans last week and this week at 5.625. Like, so I was able to, and you didn't have to have good credit.
I was about to say
640. 640.
Oh, that's decent.
And they only had to, in this one client had to pay like a quarter of a point discount just to get it, which it bumped their closing costs by like $1,000. Okay. And then the one client had to pay like half a point, which was like $2,500 or whatever. But it was like, it made sense to pay that additional money for closing costs when that half a point in the interest rate was going to save them like $150.
Yeah.
100, 120, something like that. So like the money that they spend increasing their closing costs, drop their rate, but they're going to break even in that expense within the first 12 months. And I was always taught at the very beginning, if you're going to pay points, this is a good tip for y'all listening and watching. If you're going to pay any sort of points or discount points to buy the rate down from whatever it is to you giving extra money to the lender to get a lower rate, you want to be able to recover that expense within 3 years. If it takes you 7 years to break even on what you're spending, it's not a good deal. My rule of thumb is 3 years.
Solid. Let's get to the real estate hot
or not.
All right, we're gonna zip through these joints. First thought comes to your mind. Oh wait.
I knew it. I was waiting.
Hey, Real Estate Wire Squad, where you at? Where are you at? Let me clear some room here for.
I just want to say that I lost on a technicality.
Yeah, that's what a loss is. I only lost by 1 point. Yeah, guess what? You don't get the ring.
There is some,
we put his hat on backwards for this.
Yeah, there is something called 25. FedEx.
Yeah,
but it ain't Kinko's.
Correct. So
I said Kinko's, and that's because I'm just country and I'm whatever. I lost. Whatever.
Let
me shut up and do my
push-ups. It says I've been forgiven, my son. Get down and do 25 Hail Marys. Let's make sure we can get this on camera, everybody.
I'm gonna get them done before you even. Oh, he gonna bring the smooth joint.
Let's crank them out. Here we go.
Can I do 25?
Everybody together. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 1, 2, 3, 4, 5. You start slowing down on that last one.
I ain't got it but 25. I'll give you one extra.
Oh. Marcus Fields is a man of his word, ladies and gentlemen. Never bet with a professional.
Stupid.
Good stuff, brother. Let me get you back in the ring. Yeah, man. How you feel?
Little burn.
Yeah.
I ain't out of breath like you were.
Hey, I was out of breath.
You were high level out of breath.
But I started doing a little workout, little workout.
Those push-ups got you jump started back into try to do something.
To the next one.
Yeah.
I'll bet you. No, I'm
Ain't betting you no more.
Solid,
I'm
brother.
I'm still gonna bet.
Oh, hey, that's the name of the game. You win some, you lose some. I think, but
doing it
you
with your
got
boys
one
is
win.
fun.
I'm like 5-1 right now.
You are.
I'm like 5-1, right?
Yeah.
Yeah,
I need to get
yeah,
some
solid.
back.
You
So
need
we
to
got
catch
hot
up.
night. We're
gonna run through these
Rapid
joints.
fire.
Rapid fire. First thought that comes to your mind. Are you ready?
Go.
Coffee or tea?
Coffee.
Coffee. Would you rather have the window seat or the aisle seat? Come on, let's go.
I'll see.
I'll take the window. Would you rather only eat sweet or savory foods?
Savory
Savory, brother. Would you rather watch a movie or a television show?
movie.
Yeah, I'll take a movie. Well, no, I'll take a television show. Especially if it's got like a good long series. Okay. Would you rather live a... No, I don't like that one. Would you rather never eat again or never drink again?
What?
Would you rather never eat again or never drink again?
I'd rather never
Come on.
drink. I'd rather never eat again.
Would you... Oh, here we go. Would you rather sing karaoke or dance on a stage?
Sing karaoke.
Would you rather lose your sense of touch or your sense of smell? Come on.
Touch.
Touch. I'll take smell. I like touching stuff.
Nah, give me.
Not. Last one.
I forgot. Yeah, great.
Last one. Would you rather be a house pet or would you rather be a wild animal?
Wild animal.
I'll be a wild animal. I'll be a house pet. F that. I don't want to work.
You don't like being told what to do.
Yeah, but I'd rather have that passive income. That subsidized lifestyle. I've been working too hard.
You can go create and get what you want as a wild animal. You can do whatever you want.
Yeah, but you gotta fight for your own food. We wild animals right now.
You gotta go ahead. In this market, we show up.
You eat what you kill, brother.
For sure.
So let's get to the comment section, everybody. So Marcus, you actually got a question, right? There was a question that one of your clients asked you about rent backs.
Mm-hmm.
So let's explain to us in the cheap seats rent backs and why you would need a rent back.
So I'll let you handle the part about the why you would need it, but just the basic explanation of it is when a client goes to settlement, my borrowers go to settlement, let's say the 31st of this month, but the sellers don't want to leave or can't leave. They sold the house, but they can't. They have a house that's being built and need another month or two. And what that allows my clients to do is to buy the house, sign the paperwork at the end of the month, but they don't move in to the property. The people that are selling the house are going to stay there and rent back and pay for the mortgage over a prorated amount. The maximum rent back is 60 days. So one of the steps that we always take is if there is a rent back that's involved, I have conversation with the realtors and we talk about what is the principal and interest, taxes, insurance payment over the month. That way that the realtors can calculate how many days versus how much it costs. And
Right. So basically, like say for example, that's exactly right. So say for example, I'm a buyer and I see a house that I like.
Yep.
And that buyer has an owner. Now that owner wants to move out as well. So that owner of the house is also going to need to buy a house. Mm-hmm. Now we got 3 people in this transaction already. We got you, who's the buyer, me the buyer, and I want to buy the house from the owner. And that owner then wants to buy a house from another owner. Mm-hmm. So if that owner number 1, who I am buying the house from, needs to buy the house from owner number 2, musical chairs, also needs to buy a house. But let's say, for example, owner number 2 can't move out for another, or needs to buy the house or somewhere else. His closing's in a couple days, maybe 30 days away. Mm-hmm. And then owner number 1 can't move in to owner number 2's house until owner number 2 sells his house. And so musical chairs happens where owner number 1 has to have a conversation with me. And in order for owner number 1 to buy owner number 2's house, they need me to buy their house from them, because they need the money in order to buy the house from owner number 2. So what me and the seller, I know it's confusing, but it'll stick with me. So what happens is I'm going to buy the house from owner number 1. Let's use some names. Susie. I'm going to buy Susie's house. Okay, let's use some relevant names. Shamika. I'm going to buy Shamika's house, right? Shamika is then going to take the money that from the proceeds, she's going to pay off her mortgage, and the rest of the money that Shamika has left over, she's going to buy owner number 2. Let's call owner number 2 George.
Dante.
All right. So Shamika right, look, Shamika. You stupid.
Thank you for joining us today on Real Estate.
Thank you for joining the Real Estate Wire, everybody. No, listen. So Shamika's gonna buy Dante's house.
It's so hard though.
Son, but that's how it is. It's super complicated, but
But just use 2 people though.
Nah, but I gotta use 3 people to explain the other side. Because why does Shamika need a rent back? Why can't Shamika just move out?
Shamika's number 1.
Shamika's owner number 1. She needs to buy a house, so she needs to get out. But she can't close on her new house for 30 days. She can't buy the new house until I buy her house.
So she got to pay me to stay in the house.
Exactly. So I'm gonna buy the house from Shamika and agree to a rent back, where she then becomes my tenant. I become her landlord on the house that I own. Now I need to be able to work it out if I'm renting with my landlord and say, hey, I'm going to stay here another 30 days while Shamika is moving out of her house. Maybe she just needs like a week. Let's make it simple. Maybe she needs a week to move out, right? So she needs a week rent back or 2 weeks in order to move out of the house. So we go ahead and close on Shamika's house. It's funded. Now she has some working capital. Now she can move, right? And then it may take her a week or two for Shamika to move out of her house. During that time, I own that property. It's my property that Shamika now lives in.
You already signed your paperwork.
Right. We already signed. We already closed. And now I'm basically Shamika's landlord. Now, the issue can run in, let's say Shamika changes her mind or whatever. Well, she's already signed the rent back paperwork that says she's going to move out by this particular date. And if she doesn't, well, then I got to evict her. But it's a super easy eviction because she already signed the paper saying she's going to move out at the preordained time, 2 weeks, a month, 30 days, whatever. During the pandemic, people were doing really long rent packs. People were doing like 30-day, 90-day, 60-day rent packs. I was seeing like, we'll rent back for, I'm okay as a buyer. I'll give you 90 days to move out of your house. Just let me buy the joint. You know what I'm saying? We ain't seeing that as much now. We're seeing shorter rent backs, if we see rent backs at all, because it's not as frothy a hot market as it was. So now Shamika can move out of her house. I can move into Shamika's house. I can bounce out of my apartment. And then everybody's happy. And that is a rent back. Well, that concludes this episode of the Real Estate Wire, everybody. If you're watching on YouTube, make sure to like, subscribe, and share this content with anybody that you think is dope. Make sure to hit the notifications button so that you're the first to know when we drop new content. If you're listening on the podcast, thank you so much for checking us out. Make sure to leave a comment and share our podcast with anybody that you think might find it interesting. For all of us here at the Real Estate Wire, I'm Dan the Realtor.
Mortgage Coach Marcus.
And we are out.
That was lunchtime. We were lunching today. That joke was super funny.
Like, for me, that's the first thing that came to my mind.
And the crazy part is,
and you like Dante.
you ain't never met no Dante, white Dante. Everybody knows Dante. You think that's I don't think I know about it, Dante.